Well, guess what, everybody? We started off the week with a bullish bias. You can see here the three sectors that performed the worst were the risk-off type assets. The ones that performed the best, well, at least a couple of them, consumer discretionary and technology led the way there. In today's stock market brief, we did have a bearish trigger not too long ago, so the bulls have some work to do still at this point. That's what we're going to talk about in today's episode, and we're also going to talk about some potential trade ideas as well. So let's go ahead and get into it. All right, everybody. So yes, we had a little bit of a bullish bias start to the week. But, if you really dig into that price action, what took place? Well, we gapped up on that. We'll look at a 5-minute chart. This is the price action for today. We gapped up, we rallied higher. You can just see we struggled to get any higher after that, trying to come in to close that gap for the day. So the bears had the, advantage on the day. However, the bulls started it off really nicely, closing the day up 0.34%. So relatively overall unchanged. Now, the bullish bias probably started because the yields backed off right there. The dollar backed off, which was something we talked about yesterday in the zones, how the dollar was kind of heating up there in that level. I want to call out a potential opportunity here if the dollar wants to start backing off here, if the yields start to kind of back off here too as well. That is a powerful combination for seeing gold potentially seeing some sort of a bounce. Now, gold broke down from this rising wedge, and we're seeing it pull into this target zone that we mapped out quite some time ago. You can see here it had acted as prior support, prior resistance. We had a lot of trading volume in this area. So right now, it could be potentially an oversold condition where we can see some sort of bounce here in the near future in gold. So that is what I'm looking at going forward. Now you can see here the correlation. See how this kind of slope went down right there in February for gold? Well, what did the 10-year yield do? Oh, well, the slope was nice and steady up. And guess what? That's not that great for gold right there. And you can see the same thing with the dollar. The dollar started moving with a nice slope up. Guess what? Not good for gold right there. So if those two assets start to back off, I'd imagine this could be a decent opportunity to have some position in gold. So that is what I'll be paying attention to. Now, we did trigger that bearish signal a while ago, which is really just looking at this tool over here. It's called the 5-10-20 timer. Very simple moving average timer. It's basically, you want to be bullish, you want the 5 above the 10 and above the 20, and you want price to kind of flutter within those areas. As you can see, we crossed through right here, price went up. We crossed down through here, price is going down. So the bulls, they still have a lot of price action, to get over in order to, really be more in a bullish trend, because it stands now. We have a 5, which is below the 10, which is below the 20, and they're starting to spread out, creating a bearish trend here. So the bulls got some work to do still at this point. This was right here when I pointed it out. The first thing that typically takes place on the bearish trigger is the 5 crosses underneath the 10, and when that happened, you can see that was an early indication that we might see some continued sell side, or the bulls would have to really, gain that back before the trend starts to take shape. Okay, now one thing that I will call out here is S&P 500 is below the 20 EMA. And if you look at all the 11 sectors, they're all actually below the 20 period moving average. So in blue, right, these are all from strongest to weakest over here. And they're in descending order, basically from the RSI perspective. So it's just showing us strong, 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 and it gets weaker as we go. And you can see here, they're all below that blue line, which is the 20 period moving average. So the bulls, they really need to do, recapture that. A lot of them, they're just flattening out, right? The stronger ones are just flattening out. Some are starting to decline. You can see healthcare down here declining greatly. Utilities is declining. XLRE, real estate is turning down. Energy is turning down there too as well. So like I said, bulls have a lot of work to do here. Now, if we take a look at the monthly perspective, we have a new month coming up. I just want to call out these solid black lines on the screen. Those were the monthly expected moves. Those were levels that we picked up at the very beginning of the month that we discussed. And you can see price action. If you don't know about these levels, right, you can be in the Discord. I share them there, or you can pull the numbers yourself. I have a video on how you can pull expected moves, which is, free. It's on YouTube. Now, price came all the way up there and everyone's, celebrating. Everything's all perfect, going great. We were talking about some indicators getting in overbought conditions, and we gave the heads up, and it completely reverted all the way down on its face. The S&P 500, right? A lot of price action in this month of February. It's down 2.31% so far. The Qs, it came where? It came all the way to, and we talked about it when it got here, upper monthly expected move, came outside of it, and look what it did. Reverted completely on its face. These levels here, the market priced in this risk a month in advance. So that's why it's so important to understand the difference between, implied volatility, which is, IV, future volatility, forward-looking risk, versus HV, which is historic volatility, and it shows you, what has happened really in the past. So you need to have a good combination of both of those to really determine, hey, key levels as to where price can potentially go. If we take a look at the IWM, same thing. It came all the way up here to the monthly expected move, and then it reverted right back down there. It's still really just rather in the middle of its expected move. This is only down 1.73% on the month, and then the Qs are down. Basically, they're unchanged, right? You can see that small body right there, little doji candle. Not the greatest looking, with a long topping tail. So if it starts getting below that monthly 5 EMA next month, that could open the door for further downside. This dash line is actually, I don't know if it's going to reach all the way down there in a month, but who knows if there's some sort of a credit event or something big that happens. Hey, who knows? This is the lower, this is the quarterly expected move. And you can see here, so price was basically, where did the quarter start? The quarter started right here. Okay, boom, right here. And then you can see, January. Yeah, so it started right here. It closed right here, and then we started right here. And that right there created the quarterly expected move going from just under 240 to around 300. And you can see we came all the way up to it. We got extended from it, and now we're trading back within it as it stands right now. Okay, let's continue on. I want to point out the yield curve. The yield curve is 86 basis points inverted. Pretty darn inverted, people. So it continues to just fall on its face over here. Not the greatest look. One of the best recession indicators. We were talking about soft landing. Now we're not talking about landing at all, right? There's all these, narratives and all this stuff. This is just not healthy. It's not good. So we'll continue to watch and see what takes place. And what this tells me is we got to continue to just be very vigilant on our risk management skills. Like, we can read into it as much as we want. We can try to predict whatever we want, but it doesn't really matter unless, we make money or protect our capital during the process of something, some type of event that does take place. The market, as it's been, kind of coming off, it could be pricing in it could be just pricing in, I guess, in simple terms, the Fed, holding higher for longer as it stands now. Because we were, you had the raise, 25 basis point raise, 25 basis point raise, 25 basis point, and then we had a pause, and we were always talking about that pivot going into this year, January, right, and everything, the pivot, and now you can see the pivot, it's priced out, right, or it's getting priced out here, as you can see, we're just more of a pause and holding at 5.25% for the federal funds rate to 5.5%. Now, if we take a look at just the price action alone, we came into that golden zone. We popped back through it. It was a strong start to the week, right? But we started getting rejected from where? That yellow line is the year-to-date anchored VWAP. We reclaimed the 50-period moving average. Hey, you might consider this potentially a little abandoned baby. So this might be the start to, potential little bit of a move up. So I wanted to layer on this anchored VWAP here. You might be wondering, well, where's this anchored VWAP coming from? It's coming from the S&P 500 all-time high. That's what I did, right? And we could see price action came up to this level before, or rejected. And you can see price action got above it for a little while and then just got, hammered back down through it. So if price wants to reclaim this year-to-date anchored VWAP, I would say, and it's still like a very bearish macro backdrop, this could be a potential target level to watch going forward, which is basically, I don't exactly have the exact level, but it's like 410. I'd have to pull it up. But yeah, basically right up into this prior inverted hammer candle right over here. So that's what I'd be looking for if we continue to get a move up higher, which would really just bring us to back test this prior consolidation breakdown right here. So it'd be like, potentially something like that going forward. Now, if we take a look at the 15-minute time frame, this is getting a little bit more intricate. This is why the bears still have control. We have a declining 5-day moving average. That's that purple line. And out of the gate today, right, we gapped up to it. It rejected from it, broke up through it. But guess what? We're still at a declining 5-day moving average. We're still below a flattening to potentially turning, over year-to-date anchored VWAP. So we got above it, and price got rejected from that level. And you can see here, it got rejected multiple times from that 5-day moving average, which if you actually anchored a VWAP for the daily VWAP, it got rejected here and here too as well. Now, there's a couple ways to look at this, right? You can potentially look at this as, a flag. So price broke out, now we're consolidating, and this is something we kind of drew out. Like, you get above it, you boom, you go like this, and then finally this 5-day moving average starts turning around. and we finally get to, break out of potential, inverse head and shoulders where it looks like, hey, here's a shoulder, here's a head, breaks out another shoulder, and then bam, we're right back up there to this range to try to close that gap. Hey, that's always a possibility, people. As it stands here for this week, we have 404.02 to the upside, 388.74 to the downside. Those are the weekly expected moves. You could potentially look at this like, hey, this is a broadening wedge pattern. This was kind of a move down. This looks like it. Hey, if it starts following this trend, boom, it could, continue to break down and come strike for the lower weekly expected move. So where would I see this getting more bearish? Well, if we take out today's low, I think that opens the door at least to take, try to go for this Friday low right here. And if we start taking out that Friday low, it's not looking all too healthy overall. But as it stands right now, this move up into a declining 5-day moving average and into a neutral year-to-date anchored VWAP is pretty normal. Like, I wouldn't want to be a buyer right here, right? It was a strong move in it, so you're chasing at that point. So as price is pulling down to fill this potential gap, maybe undercut it, who knows, and do something like that, that would be completely normal in my opinion. So that is kind of what I'm watching for going into tomorrow's trading session. Speaking of tomorrow's trading session, if we take a look at Bookmap offers all my subscribers a really good discount. The link is below in the pinned comment section. This is what I use for intraday trading. I use it sometimes for swing trading and getting key levels for, but intraday trading, it's incredibly helpful. If you've heard of level 2 data or market depth, it's like taking the blindfold off, okay? You get to see, well, first off, I'm not good at reading the level 2 data where it shows the bid ask and it has just, basically looks like this with a bunch of numbers flying through the screen. This paints that into a heat map form, and it allows you to see where liquidity is, right, from a heat map perspective. And what I'm seeing here, right, so this was today's trading session on ES, boom, right to close, okay? And then obviously the market closes, and here I saw some key levels highlight. So these are going to be levels that we want to watch tomorrow. So that's 40.30 to the upside. We have 39.70 here, but we also had this level light up, which is basically around 39.50, this zone in here. And then we also still have this 3900 kind of just sitting out here, quite a bit of orders. We have one other level there at 40.65 that kind of has been sitting there for a while too. So going into tomorrow's trading session, I would be watching these levels for price action to potentially, bounce from. They can act as levels of resistance, or when they're broken, that might, you might potentially see increased volume where it could see some sort of a flush more to the downside to the next key level. Okay, so that's what I'd be looking for. If we take a look here at the updated zones, you can see now, right, we talked about the dollar, how it's bright red. Now, guess what? Now it backed off a little bit. So where is it as it stands right now? Well, it's at 104.63. That's above the middle range still. So it's pulling back to the middle of its zone. So that's all that's doing as it stands right now, and it offered some relief today. A couple of things that are in the green are silver, right? Gold was basically there the other day. Actually, was it there the other day? I believe it was. Yeah. So no, it wasn't. So gold was not there, but it was not too far off. Silver was there. SPY was there. There was a lot of green on the screen, and well, the bounce kind of it clears off some of that green, puts things into the middle of the range as it stands now. If we look at the S&P 500, so the middle of the range is 40.45. We close at 39.82. Okay, so 39.82, we're not too far off from the middle of the range. And then when I look at like yesterday's data, or it was 40.45 today. And now if I look at yesterday's, it was 40.57. So the middle of the range is actually moving down as price action's coming into it. Remember, I tell you that these middle of the ranges, they can potentially act as identifications for trend changes. So that could potentially act as a level to watch out for. As I look at this is the SPX, right? And if you look at ES, it's 40.42. That's the middle of the range. We go back to Bookmap, and hey, what do you know? Right around that 40.30 to 40.40 is up here. We have this kind of area that's been highlighted up here. So that could be, like I said, some more confluence of an area of resistance. If price action can't get through it, it could be a potential level of resistance. That's all I got for you on today's episode, everybody. We talked about a lot. Hope it helps out for tomorrow's trading session. If you haven't done so already, make sure to hit that thumbs up button, smash that subscribe button. It's greatly appreciated. Thank you much.